Wonderful. Okay, so let's get started. So again, hello everybody, to all of our viewers and listeners around the world. We have a good attendance tonight, and we had a lot of signups, almost 400 signups. So this is a topic that is interesting for a lot of people. Tonight's topic, as you know, is central bank digital currencies versus DeFi. The question is, what is the future of digital currencies? And I'm very pleased that we have such a wonderful set of speakers tonight for you to shed some light on this question. My name is Chris Ebell. I'm a member of the Crypto Valley Association on the team there, also an entrepreneur and a business consultant in technology. But tonight, or today, I should say, we are going to explore that topic a little bit more. And as you know, there is, let's say, a little bit of controversy around, where you should place your trust. Is it the government? Is it a fully decentralized set of projects? And how's the future of this going to look like? So I would like to start with a tour de table, as we say in French, and have every one of you on the panel introduce yourselves quickly, give your name, your affiliation, and perhaps already one or two thoughts on where you are, so that our viewers can locate you on this map of opinions where you might be. And I'm going to also introduce specifically, or I'm going to start actually with Hsin-Ju, who is co-moderating tonight with me, and the division of labor is going to be a little bit, she's going to jump in more at the end when we do the Q&A, which we'll do as well. And so we want to give ample time to also questions from the audience and to the opportunity to interact with our panel. Okay, so Hsin-Ju, can you get started and just talk about who you are, where you're coming from, what's going on?
Yeah, of course. So name is Hsin-Ju. I'm the CEO of Dystopia Labs, and I was the former head of growth at Stellar, Solana, and a director at Tezos. And I'm glad to be here. I'm based in the US.
Wonderful. Thank you very much. I'm just going to go right to left on my screen here. Robin.
Yeah, hi, everybody. Good afternoon, good evening, good morning. My name's Robin Rennick. I'm here with a couple of hats on, I suppose. The first is my professional hat, which is as my day job with a research analyst with a company called Trilateral Research. We are primarily a research company specializing in data protection, privacy, ethics, and human rights. Our main client would be the European Commission. We currently work on about 30 Horizon 2020 projects. And we also boast clients such as the European Data Protection Board, the UK Ministry of Defence, and the United Kingdom Research Institute. I guess my second hat here, which is maybe a little more interesting, is that I've been a Monero contributor for the last 5 years, I would say. So a very active member of that privacy-preserving cryptocurrency community. I'm sure you all know. Thank you.
Very cool, thank you. And I think that's a very key concept here, trust and privacy/privacy for this. And I'm going to definitely also come back on the question of EU and a little bit sort of the geopolitical context, because the concept of privacy isn't the same everywhere. And so that's an interesting point as well. Thank you very much. All right, Gino.
Hi, everybody. My name is Gino. I'm a regulatory lawyer, and I'm heading the RegTech unit at Signum. Signum is the world's first digital asset bank, and is exactly at the forefront of the digital asset economy, where we empower our clients to invest in digital assets with complete trust.
Excellent. So there's the word again, trust. And Signum Bank, we'll just talk about also a little bit about banks kind of going into crypto. We've just had news as well in Switzerland here that one of the sort of oldest private banks in Switzerland also starts offering. And I think they're actually working with you guys, right, at Signum, is that correct?
Yes, that's correct.
All right, so very interesting also that, we're having service providers come in, or banks helping banks, so to speak, which is a very cool concept as well. Jason.
Hi, everyone. My name is Jason Truppi. I am co-founder of Basket, which is a stable security coin based on a basket of global currency bonds that produces a yield. So very relevant for the topic today. My background is been an entrepreneur over the last several years, but prior to that, I was an FBI agent in New York City. So I worked complex crimes, specifically cyber crimes in the US, worked with every major exchange, bank, regulator, and law enforcement agency that you can think of. So I have a good government perspective, which I'm sure will come up in this conversation as well. And prior to that, you know, I have a computer science background, formally trained, but had primarily been really in cybersecurity and you know, building technologies.
Fantastic.
Oh, and I reside from West Coast, United States. Thank you.
All right, wonderful. So good morning to you, and great to have you on board here. I think as you guys can see already, I think we have a very broad perspective. We're also kind of hoping to get maybe our speaker from the Swiss National Bank. I'm not sure, he might be a little bit later. He might come in, Thomas Moser.
Chris, actually, I'm here. Yes, I'm here.
Oh, you're here, Thomas. I didn't see you. I'm so sorry. So that's okay. It was my first tech fail of tonight. So Thomas, please, you were here, and I'm very, very happy to have you on board. Thomas, like the reason why I asked you is really to be on board, because you have emerged, I think, over the last 1.5 years or 2 years as one of the leading voices on central bank digital currencies in Europe, and also a practitioner. So you're not just a theoretician who kind of observes, but you're actually on the board of the Swiss National Bank, and you just published a paper that I want to also really highlight for everybody. And I think the title of the paper is "How to Issue a Central Bank Digital Currency" or something like that. And we'll definitely want to hear more about this, but maybe you can introduce yourself quickly to the audience and just give your first perspective.
Well, thank you very much, Chris, and thank you for having me. So as you already mentioned, I'm an ultimate member of the governing board of the Swiss National Bank, which is the Swiss central bank. So I would be the CBDC part in the CBDC versus DeFi. And actually, I guess I would also be your alleged trusted third party in this discussion. And as you said, Chris, I mean, I have been interested, or it's probably be more fair to say fascinated by blockchain technology and now also DeFi for several years. So I'm following it very, very closely. So thanks for having me.
Fantastic. So, okay, thanks to all of you guys. My first sort of question to you or to the panel really revolves around a concept that we've heard a couple of times already in your introductions, and it's about trust. And it seems to me like we're just following the discussion. If you just go one step back and look at it on a meta level, a lot of the issues that we're talking about today actually intersect at this concept of trust. And my question to you is like, where does trust really where does it get placed? Because you have to, you know the expression, you would place your trust in somebody or something, right? So you kind of put that somewhere, and a lot of your white papers or theories that you have is like providing a location for that trust and a solution for putting it there. So I would be very interested, maybe we could start with Jason, because like, you know, just taking from your perspective, because it seems to me that you said like, I worked in cybercrime and cybersecurity, and now I'm working in stable, in a coin area. You seem to have found perhaps something that can help solve some of those issues. And can you talk to that a little bit?
Chris,
Sure. Yeah. Oh, go ahead.
To interrupt, the audience is saying that it's really hard to hear you. So if you could just move closer to your microphone, that would be great.
No, okay, no problem. I can put this a little closer like this. Is this better? I hope this is better. Let's give it a little bit more gain. So here we go. Should be better.
Yeah, Chris, thank you. I think about this a lot, actually, you know, obviously with my background in cybersecurity, but I'd like to talk just about trust in general and how people, you know, trust things and people, and then we can kind of get into, you know, the trust of the world we live in now, which is the digital world. So, you know, trust is really, it's localized, it's regionalized, and it's nationalized, right? You kind of have these different bubbles of trust that you have. During this time of COVID, you have your trusted pods of people that you interact with, that you feel have the same level of due diligence on their daily activities. That this has become this notion of a pod, right? And so these trust circles happen again, locally, regionally, and nationally, and it's a very complex type of topic, because how do you actually trust someone? We think about people actually contracting COVID from their pods because they trusted that everybody was doing the same thing, right? And so trust inherently comes from experience with either people or processes or technology, right? So you spend a lot of time with a friend of 20 years, and them inherently, and you can trust that they will do the things that they normally do because you've been around them a long time. So sometimes it's similar to a bank. I trust the bank because I've had my money there for a long time. I've received some level of interest on my money, although these days it's not much. But they've never lost my money, and if they did have some sort of breach, I usually get my money paid back, right? So again, that it comes with experience, it comes with length of time. Now, when you translate that over to the digital world, it's a completely different ballgame, right? You have someone like me where I don't trust anything that is digital in nature, because I've seen every single type of thing that has either some sort of hardware or software involved that could be compromised in some way, shape, or form. So then you actually have to, in the digital world, you have to think about risk. When I'm going to make a transaction online, whether that's my traditional bank or through some sort of exchange or some sort of DeFi, swapping, website, you have to think about, how the security of that technology is being formulated. Do you trust the team that's working on that project? And do you have the technical knowledge to understand those white papers that you mentioned? So it is a very complex thing. And I think, when the crypto market really started to flourish is when, people started getting smarter and understanding that they have to do the due diligence on the teams, that are in the space. You can't just, well, you can, but it would be very risky of you to go to some exchange that you did no research on and go put your cryptocurrencies at risk. A lot of people are a lot smarter now. And so the things that I look at are, team, the technology, and then of course, security in the digital space. And we can talk a little bit more about that, but I'd like to open it up to the rest of the group.
Very cool, thank you. So if you talk about the team, like you gotta trust the team, like what if your team is your central bank? Thomas, what is that where you should place your trust as a citizen, as a consumer? As you say, like, okay, I know this team, they're not always perfect, but like they've been doing this since a long time, and I kind of forgive them for giving up the gold standard. So.
I think it's like Jason said, it's many things, but it's especially experience. So trust, has something to do with reputation. So when you talk about a team, that could also be about the reputation of the team. But reputation, I think, eventually comes down to accumulated experience. So if you see that something has worked for a long time, as Jason mentioned, maybe with a specific bank, then you tend to have trust, and your trust increases. And I think it's the same with central banks. Some of the central banks are more trusted, some are less, and it depends on the experience that people had with the currency issued by these central banks. Of course, the problem with trust and reputation is that it can be gone quite quickly. You start making mistakes and you can lose that trust, and it's very difficult to gain it again. But I think in the end, it's really this, that you just experience it, that you see other people's trusting. I think generally people are extremely trustworthy, and you really have to violate that trust to get a negative effect. But people are quite ready to trust other people and to trust projects if they look good. And I don't think that a lot of people will go into white papers. There are a lot of people who do not understand the technical issues, but they see maybe the name, they see that a certain person has achieved some things in the past. They see colleagues trust this specific product. And I think that's how trust builds. And the experience, if there is good experience, it will just accumulate and trust will increase.
Okay, so that's for projects basically, but we're also obviously talking about whole economies, you know, being sort of transforming into more and more digital economies, and banks are catching up on the one side to try and figure out what's going on, to capitalize and to also enable this kind of new digitized economy. I would be interested, Robin, maybe from your perspective. When you talked about EU projects, EU regulatory aspects, right? When trust is good, but control is better sometimes. You know, like I think, was it Ronald Reagan who said that? You know, just, you know, in connection with the Soviet arms race, the U.S.-Soviet arms race. So you got to have sort of this additional layer, and a lot of people are seeking this in, and governments are seeking this in regulatory aspects. And Robin, what's your experience there when you talk about EU specifically, perhaps as well, also in relation to other jurisdictions? What's your experience?
Yeah, I guess first, before I talk about kind of the European perspective, or at least my understanding of the European perspective, I think it's important to kind of understand the sort of ontological nature of trust, right? It's sort of a vertical, a horizontal, and it's multi kind of contextual and dimensional, right? Important elements of trust are things like transparency, accountability, and verifiability, which in a digital world are in some ways easier to achieve. At least in the cryptographic world, where security is underpinned by, you know, mathematical rules, it's easier to verify whether or not something is what it says it is, right? The problem with the world we live today, or at least some perceptions of, for lack of a better word, central bank or the central bank system, is that it's very hard to look transparently into what they're doing. It's very hard for any of them to really be held accountable. And it's very hard for the average citizen to verify any of the actions or decisions that are taken at a central bank level. In terms of the European perspective, I think it's basically looking at the trust stack, right? So you know, you have trust at architectural layers, at network layers, at protocol layers, and you also have trust at the human layer. We could talk about what that means at a human layer. It's pretty complex and it's based on psychosocial phenomenon, but there's also trust at the regulatory and policy layer. And I think that that's what the European Commission is very strong and very forthright in doing. They want to set up agreed trust frameworks, whether that's with regards to data protection, whether it's regards to data governance, or whether it's regards to, you know, competition law or consumer protection law.
Yeah.
And I think what's lovely about the Commission is, well, at least my perception is what's lovely about the Commission is that they try and make the development of those trust frameworks a very inclusive process. So they have this better regulations toolbox, which is essentially a way for the public to get involved in the policy shaping. Right. And I think it's very important because that adds a level of accountability and a level of transparency to the whole process. You know, and in this space, we've recently seen the market and crypto assets regulation come out, or at least a proposition for the MiCA regulation. And it's gone through a consultation period. And one would hope that some of the consultations that are received by the Commission would be integrated into the finalized version. And I think that's important. With respect to building trust between citizen and state.
So this means, Jason, I'm sorry, Robin, this means that you can, like, people who are now listening to this or watching this can actually go on somewhere on the website in the Commission, European Commission, and actually participate actively in or shaping, at least to a certain degree, the regulatory framework for crypto assets or crypto regulation, right? That's what you're saying.
Yeah, exactly. So there's been a number of what they call better regulation consultations. So that the big one recently was the market and crypto assets. There's been a couple on EU digital identity, which interface quite strongly with the AML KYC world. And there was also a really interesting consultation on.
Say what that means, AML KYC.
Oh yeah, anti-money laundering and know your customer. So, you know, the whole concept of digital identity and verifiable credentials may or may not be based on blockchain systems, but it's essentially a way of creating a greater level of trust as individuals or citizens navigate the digital world.
Right. Okay, cool. For regulatory aspects, it's always interesting. You know, there's like people who like it and people who don't like it, and it's like sort of one of those contested areas as well. I'd like to know from Gino as well, you know, as a bank, what do you need in terms of regulatory framework and what do you not need? Like, obviously, you're existing in Switzerland. Apparently, there is a framework that works. You can actually have a bank that is focusing on crypto. Can you just give us a quick idea of like where you locate regulatory as an important piece of your innovation, or even the selection of where you're going to be as a bank?
Chris, could you please speak up a little louder because our attendees still can't really hear you well.
Okay. Yes.
Okay, in terms of regulation and innovation, and this is a very interesting field, or the intersection is very interesting. And this is also where I do make my living, at this intersection of regulation and technology, which drives massively innovation. And here, as in most topics, if you go too much in one direction or in the other direction, you won't achieve the best results. There is sort of the middle, the golden way. On one side, regulation provides trust, because regulation leads to enforcement, leads to supervision. That means people can put their trust into regulated entities because they know in case of something happens, there will be people accountable, will be people prosecuted. On the other side, if the regulatory framework is too tight, then you have not much opportunities to innovate, to design new products, to bring new products into the market, to test it with people. And here, and this is exactly what where I would like to follow up with Robin, who made a great statement. Regulations, if it goes through a consultation phase where actually affected industry participant can provide their input, because they can already anticipate what would be the effect on their side, on the market, on potential customers. If we can have here an inclusive process where information can be shared, because it's always easy to regulate something which already happened and went wrong, right? But then you're too late, right? So, and now you can say, okay, we forbid everything, we over-regulate, then nothing bad can happen, but then also no innovation can happen. And sometimes you cannot regulate in advance because you simply don't know the risks yet. One example is, as example, nanotechnology. In the very early beginning, when it started with the regulatory initiatives, there was not fully clear what sort of use case, what sort of products can be put into the market. And here is some flexibility required. And this is provided by principle-based regulation, where we do have in Switzerland a very good approach, because at the end of the day, regulations also needs to take a risk-based approach into consideration. And people or regulated institution needs to assess what is the specific risk, and then based on this risk, measures should be taken rather than just to over-regulate it.
Absolutely.
Yeah,
Yes.
Chris, do you mind if I jump in there on that as well?
Please.
I just have a comment there. So, you know, if you look at regulation and law, and this is for all globally, but I'm going to be speaking mostly for US law. You know, most of the regulation is rooted in some sort of crime, mistrust, mistake, or abuse, right? The problem with it is that it's compounding. So as those mistakes happen, or those frauds or those crimes happen over time, you know, the regulators add laws and they add regulation, right? But they rarely go back and review that. So they're not innovative in a way that is keeping up with, you know, the digital age. And so you have all these, you know, quote unquote, old laws that don't really apply to modern technology and modern finance. And, you know, this even is applied to just kind of general rule of law. And that slows down the innovation in the space. So there is this golden kind of center that I truly believe where, you know, we can have a safe, you know, digital, you know, payment system or digital transaction globally, where we're still, you know, knowing the transactions, we can trust the system, but there's still some regulation and capability for when there is some sort of fraud or crime, because we can't have just a purely lawless, global monetary system. And it kind of was that in crypto in 2009, 2010, right? And it didn't work. But now that the trust has, now that traditional finance and governments have really taken to cryptocurrencies, we're starting to see more trust, which now we're seeing more volume in these markets. And I think that's a good thing.
Absolutely. Robin and Thomas, do you want to jump in on this as well? I think that's a really interesting point. And also the question perhaps, what is technology's role in this whole thing, right? This is a tech question, right? It's like, how much can we actually build into our currencies and our digital currencies that actually perhaps even make compliance easier with regulation, but also kind of inherently are better than certain other systems.
Just quickly, and maybe Thomas can answer this question because I'm a bit ignorant to this, but as far as I'm aware, there's no regulatory or policy framework which governs the actions and decisions taken by central banks with regards to monetary and fiscal policy. Or is there? I didn't think there was.
Well, I mean, yes, there is. I mean, there is, first of all, a constitution and then the laws that give restrictions to what a central bank can do. So it depends on how detailed you want to go into regulations of, let's say, monetary policy. But there are long discussions among central bankers also about rules versus discretion, for instance. So this is clearly also a topic in central banking.
Right. Thomas, while you're talking about this, in terms of central banks and their actions, a lot of discussion has been recently going in the direction of inflation, of printing money, of the whole stimulus packages all over the world, and some people say this is driving really people into DeFi, into coins where they feel like there's more trust or there's some kind of stability that, in a way, the policy-driven central banks no longer provide in the same way that has been, and it has been eroded for a long time. And now we kind of have a technological answer to this, and then sort of the central banks, and you could argue, central banks are now looking at their their instruments basically that they have at their disposal, and they're saying, well, you know what, we can also do this, and we're going to basically create some kind of competition out there towards those other coins. How would you frame that as somebody who's really on the ground yourself?
Yeah. I mean, first of all, as you said, I think people have been clearly watching the large increase of the balance sheets of the central banks since the financial crisis 2008.
Right.
Now, in the past, this money creation had a very tight link to inflation, but that kind of started breaking down in the 80s, late 80s, 90s. Most central banks moved away from monetary growth rules to an inflation targeting. Now, the big inflation didn't come after the balance sheet increase. Now, recently with the COVID pandemic, we had another large increase in balance sheets. And I guess, as you said, I mean, that story goes around that now people are moving into cryptocurrency stablecoins. Now, the interesting thing that I observe is that when you look at stablecoins, the majority of stablecoins, they link they peg their value to the US dollar.
Right.
So that means basically they trust the Federal Reserve to keep inflation low. So they are exporting or delegating the monetary policies to the Federal Reserve System. So that narrative doesn't really go well together for me. If you don't trust the central banks, don't peg the stable coins to a fiat currency.
Right. So that brings me good point. That brings me to maybe Jason and how do you do this at Basket? What's the where do you place your?
That's a really great segue into what we've at Basket have built over about a 2-year period. So we've been very interested in stablecoins, well before, the craze of last year and the DeFi swapping world, where stablecoins really got their high volumes. One of our exact points was, don't peg a stablecoin to a one-on-one currency. It is actually inherently risky, even if it is even US dollar or the European, the euro. And that is exactly why we decided to create a stable asset that is backed by a basket of global currencies that in some cases are unrelated. So essentially you're hedging your risk across multiple currencies globally. And that allows you, and obviously in investment and institutions use these methods in things like ETFs and others, right. Mutual funds, et cetera. They use the same technique in the traditional finance world to gain, small marginal yields over time. Well, what's nice about that is we're doing essentially the same thing, only we're allowing the liquidity capability, and we're bringing that liquidity capability to blockchain. So it's essentially a digital asset that has true backing in the traditional financial markets. What's complex about this, and by the way, the SEC here in the US is comfortable with this type of asset. They've already approved other types of assets, so it's very likely that we'll get through the approval process here in the next few months. But the point is we really wanted to create a stable asset with a yield because we're starting to see more and more the ability to drive transaction prices down by doing that. So think about payment rail systems. For example, if you want to send a payment to a developer in Thailand, which I did last year through PayPal, you are looking at a 8 to 9% international transaction cost. Right. So you pay that developer $2,000 a month, and they're taking $200 away from them, which in Thailand could be several days worth of food for a family. So we were able to do the same process using USDC for free. So and they were able to get liquidity in the same amount of time, and then also reduce that transaction time significantly down to minutes rather than days, weeks, or months. Right. In many cases. So that's kind of one area that we're thinking about. The other area is in these DeFi swapping pools. So when you look at these paired pool assets with stable assets and Ethereum, stable asset and Bitcoin, et cetera, the stable asset actually brings the yields up for stable asset holders pretty significant. Right. So adding an additional yield to that stable asset just increases the overall yield of the staked swap asset. So we're looking at that as well as a function of our tool. I would highly suggest that anybody who's building a stable asset not peg it to one particular asset class, and that's exactly what we were saying, Thomas. We totally agree with you, and that's exactly why we're doing what we're doing.
Very interesting. And what are the other perspectives on the panel on this? I mean, there is disruptive technology in DeFi for sure. There's the markets aren't mature though, and you get those different like competing concepts here. And what do you guys say to what Thomas sort of this charge that Thomas said, or like this challenge was that like, how do you claim to be independent if you're actually pegging your currency or your coin to essentially central bank policies in a certain way, and trusting them to keep stuff on sort of a trajectory that's stable? What's your perspective, like Robin, Gino? What do you see?
I mean, I'll jump in here and I'll be quite forthright.
Please.
I think DeFi is like the worst of Wall Street combined with the worst of the marketing world, put into one big hot tomato money soup, right? What's even worse is that Jason there, with all due respect, I'm sure your product is fabulous, but Jason there is telling us to trust a pegged asset and trust the company, not the government. So even worse than trusting the government, who I think is benevolent for the most part, we need to trust a corporation that's registered and very light touch regulated by the American regulators. I would not advise doing that at all, right? Secondly, I would not advise anyone to use some of the wrapped assets based on Ethereum, essentially because it's a privacy nightmare. And not only is it a privacy nightmare, but essentially you're leaving a data trail which is going to have huge ramifications once the AI and machine learning based algorithms are going to be trained on all the transactions on the network. And then that is sold to the ad tech industry, who is going to target you with their adverts and their behavioral manipulation, right? That's my view. I would hope that CBDCs and at least those in charge of designing CBDCs would recognize that risk.
Right.
But I'm not sure if they do.
So a dark scenario really that you're painting there, and I think an interesting one to consider is that something that people in the DeFi space, and I'm gonna be honest, I'm also in that space to a certain extent, but I'm also in a space where in an EU project where we are designing processes for supercomputers to use artificial intelligence, so that basically multiplying the power, the computational power, and putting AI in. You're basically saying that this is going to disrupt again the whole industry in a certain way, that stuff can now be traced and tracked that we don't currently believe cannot. And but is that a sentiment your clients, Gino, what are they seeing? Are they just short term right now? They're just kind of in the craze and they just want to be part of it? Or are the clients of your banks like this, the Geneva bank that you just converted, so to speak, or who are now also offering those assets to their clients? What is the sentiment there, and what would you say to Robin? To kind of who put something on the table? I think that's not easy to just kind of dismiss.
Mm-hmm. I mean, digital assets are here to stay. It's not a short-term engagement. We have seen the numbers growing massively, and I'm not talking here about market prices. We have seen more and more use cases, especially in the tokenization world. And I do agree with Robin, and this is coming back to one of our main topics. It's about trust. Yes, I can have trust in the distributed ledger technology, which prevents double spending. But if a token is representing something off-chain, then who guarantees that actually this something in the real world is actually there? And especially for stable coins who are packed to a basket or a single currencies with all the pros and cons, who is guaranteeing that actually this fiat money backing this coin is actually there? And this is where I fully agree with Robin. You have not only to have trust in the technology, but also trust in the intermediaries or in the parties involved in these processes. And typically with stable coins, you have an issuer, somebody who has structured and designed this token, somebody who has potentially somewhere a bank account, actually having in one or several currencies this underlying packed money. And then is the question, okay, if I want to redeem the underlying, because at the end of the day, there might be people for whatever reason who want to go back in the old world for a specific transaction or for a specific amount of money, and they need to have trust that they actually get what they were promised to get.
So a very old problem, basically. You're talking about one of the reasons why we started to have central banks in the first place, right? Basically to prevent or to be able to provide a certain liquidity in case of what you would call a bank run, right? That's kind of what you're alluding to. And I think we're also seeing this in the recent discussion around the Tether coin, right? In the US, where exactly those questions were raised. Is this actually backed by the assets that they claim they have? And it's an age-old problem, right? I don't know. I mean, Thomas, you probably have the history there all together, but like that's where this is coming from. And Jason, I don't know if you've seen anything in that area as well, in terms of crime or in terms of also like attempts to utilize this sort of situation, and it's been in New York. I mean, that's right where it happens right now.
Yeah, I mean, I totally respect Robin's opinion, but I will say, first touching on the AI machine learning, I've been involved even in the early days of high frequency trading platforms, which were using essentially, not artificial intelligence algorithms, but algorithms created, through, correlation engines and things of that nature that have been affecting the traditional markets for years. Those have since moved to AI and machine learning techniques that make them even more efficient and trade faster. So the traditional markets are already being affected by AI, and therefore the crypto markets will be as well. And that is a very scary thing. So I agree with you, Robin, that the future of just finance in general will be run by machines only, and it's going to be very interesting on how we're going to trust that system that's no longer run by humans. The second piece is I do need to defend the digital asset that we're creating. So the difference here on Basket is that we are fully regulated. So if you look at any other security token that's out there, they are unregulated by those entities in the federal government, which means, companies like Tether did not have a custodian here in the US for their actual physical fiat assets. We have that. So that means any investment we make in global currency bonds actually has to be, transacted through a transfer agent and a custodian, just like in traditional finance. So we can actually validate and verify all of the money that we've spent in our digital asset. So that's very, unlike any other digital asset that's out there today. And that's the reason why we did that was for exactly that reason, Robin, because you can't inherently trust corporations to secure your assets. And that's why regulation is actually in place to do exactly what we're doing. So I think we're a really good mix of trust, but also still having the flexibility and liquidity that you would get in the digital asset world. From a fraud perspective, yes, I am very, very scared of the DeFi world. I can tell you that for a fact. While I think it's really, really strong that a community can get together and create some market or some financial market together, I think that's really great, as long as you have some sort of inherent security procedures and capabilities within that community that you trust. Where it's going to get sticky is that you start trusting communities that eventually break down for whatever reason. I'll give you a very basic example, which was not a fraud example, but it is an example that just happened just recently. So Uniswap just recently had a bunch of stable asset and Ethereum and Bitcoin and top 10 cryptocurrency pairs. They were incentivizing users of the community to essentially stake their assets in these swapping pools. Well, at the beginning of December in 2020, they had about $3 billion worth of assets that are locked up in these liquidity pools. As soon as they turned the incentivization off at Uniswap, those assets dropped 40% of the assets that were being staked. So this is not a fraud by any sense, but it's a community that says, is basically telling the corporation that if you don't incentivize us enough, we're going to pull our assets and put them somewhere else. And a lot of people switch to another swapping tool for that matter. So it's not just fraud; it's also economics as well.
Right. On immature markets, perhaps to a certain degree, right? I mean that just they're really. It's really difficult to discover price for such assets, right? It's even harder than in the real world. Maybe we have a couple of minutes left. I think I want to also give people the opportunity to then really ask questions or to engage in discussion. But Robin, I would be very interested to hear from you. Do you see any tech solution, so to speak, to this? Because you also said you're a contributor to Monero, and maybe that goes in that direction of where you can actually do something on the tech, and maybe not a tech fix, but something that can be done. And then Thomas, maybe after that, after Robin, not all central bank digital currencies are created equal either, right? So there must be differences, and then what's going on there. But maybe first, Robin.
I mean, that's a really hard question because I don't understand what we're looking for the solution to, right? I mean, I look at a lot of DeFi and I'm a bit of a cynic. I mean, it's essentially just peer-to-peer slot machines, right? That's kind of what I think it is. Of course, there are some really powerful affordances, you know, in the line of financial inclusion and the democratization of financial instruments. But I think it's not going to end up being fair for all participants unless there is very clear and very concise regulatory oversight.
Right.
If we don't want the oversight because we want to live a libertarian dream, then all's fair in love and war. And you know, let there be no rules and let the winners come out on top, who will be the ones that have the most capital to start out with, and the losers will be the average Joe. I don't think that there's a solution for that, because I think if we look at the history of the world, there's always been an unequal distribution of power, and more now than ever, an unequal distribution of wealth.
Right.
I don't see that changing. And
you see it more as an amplifier for those currencies rather than
if you look around, you know, undoubtedly there's been a lot of good to come out of the blockchain revolution, but there's also been an awful amount of bad. And I think that's the
yeah. I'd love to hear from Hsin-Ju, please.
All right, question. So Robin, I know you mentioned AI, big data, and privacy. I assume when you mentioned that you were talking about on-chain data with like chain analysis and cipher trace, like tracing transactions. With like stable coins, like being issued on like open networks that aren't private and potentially wrapped CBDCs, like, is there any way to fix that aside from like making the base layer actually natively private? Because like the only other way is for people to use something like Tornado Cash, and that's like not the ideal solution. So I'm just like kind of curious when you talk about privacy in that sense, because it seems very hard for projects to have that when the base layer isn't private.
No, it's not very hard. There are a number of base layer protocols that are privacy preserving, whether that's the CryptoNode protocol.
But with smart contract.
Whether it's the Mimble-Wimble protocol or whether it's other privacy preserving technologies such as ZK rollups, deterministic rollups, or even Tari, which is being built as a merge mine of Monero, which is a CryptoNode protocol and is smart contract, well, supposedly will be smart contract enabled. I think that there's been again, this is my cynical hat, general willful ignorance in this space regarding privacy. I think it continues to this day, and nobody wants to discuss it because, as I said, they want to live blindly ignorant and continue on, or they're malevolent. It's one of the two. I don't see it any other way. So the solution is to use the cryptography that is there. That's why it was built. It's why it exists. And to put the regulation and the regulatory framework in place to ensure that data protection and the fundamental human right to privacy is maintained as we move forward. Whether or not it will, I don't know.
Yeah, super interesting. I think this discussion between really privacy being this at the core of cryptography, but then also in this case, driving, as Robin says, driving certain problems that are already tendencies that are existing. I find this an interesting discussion and also interesting controversy, which I'm sure is something that also is replicated in the broader public, and that's something I'd love to hear about. But Thomas, first, before we go to questions, I would love to hear about sort of your vision for central bank digital currencies as maybe addressing even some of the problems or issues that we've just heard about, and also maybe comparing a little bit different currencies. We've heard in China there's the digital RMB is being actually sort of beta tested currently as we speak by consumers. We have in South Africa, we have projects all over the world. Most central banks are on it, and you just published this paper together with one of the inventors of digital cash. So I think that's what it was called, in fact. So very interesting perspective. I would love to hear what you think.
No, thank you very much. I actually, the issue that Robin raised about privacy, I think is a very important issue when it comes to central bank digital currencies, because there's clearly the potential there to have easy mass surveillance, depending on how a CBDC is designed. So as you said, a lot of central banks are experimenting, piloting CBDCs. So you see very different things. You see blockchains and non-blockchains. Uruguay, for instance, is not on a blockchain. Then you have a lot of central banks experiencing with permissioned ledgers, a lot of enterprise blockchains, which are very, I guess, very special. That they also allow to have some kind of confidentiality for the banks that are involved. But for me, the privacy issue is an important issue, and I think it's slowly gaining importance in the central bank community too. So as you nicely mentioned, the paper we just published together with David Chuang, who is one of the, I guess, champions of privacy. He's the inventor of blind signatures. And that was exactly, I think that's the only really advantage that the CBDC design has that we propose over a lot of other CBDC designs, that it can provide this transaction privacy through David Chuang's blind signatures. I mean, the other thing is that we are not using a blockchain, so it's very scalable. We can do several thousand transactions a second. And one question I would be interested in, Robin, so my understanding is that a lot of the cryptographic privacy protection technologies used on the blockchain are problematic in terms of scalability and performance. But I would be interested in an update on this view.
Yeah, I mean, quick and easy answer is yes, it's problematic from a scaling perspective, you know, especially if you're talking about CBDC, which is, you know, a national or global framework.
That's exactly why we didn't use a blockchain, blind signatures without a blockchain.
Yeah, I mean, but there are, I mean, Mimblewimble is a really interesting protocol, and it has this concept of cut through, which essentially allows, well, at every block, at every block verification, it allows you to ensure that all inputs add up to all outputs, and then you can essentially make a cut of all the previous blocks, and it gets aggregated down to a hash, and then that hash can be verified. Now, if obviously you need some evidential framework to be able to, or an evidential framework in place to be able to look at transactions post some time and date, Mimblewimble is a little bit problematic. So for CBDCs, it may not be suitable. But to answer your question, yes, as from a scalability perspective, it's still an issue.
Wonderful, thank you. So, Hsin-Ju, should we go jump into the questions in the Q&A, and have some of our viewers actually ask those questions, and then maybe at the end of this Q&A session, we'll give everyone on the panel also a sort of a chance to for final thoughts. But let's jump into the Q&A.
Yeah, sure. So I'm just going to pick and choose some questions that I think are relevant. And I will mention the name of the person that wrote it, and I might be butchering it. So Sarah wanted to know, how is risk scoped in terms of like CBDCs and stablecoins?
What's about risk? Sorry, I didn't hear the.
How do you scope out risk when it comes to stablecoins versus CBDCs?
All right, who wants to take that one?
So maybe just for CBDC, I can say that within a certain currency, that's exactly one of the advantages, I think, of CBDC, because you do not have this credit risk and liquidity risk, which you have with private money almost by definition. So that's I guess one of the advantages and one of the reasons why a lot of times, if you have a systemically important financial market infrastructure, you want the settlement to be in central bank money. So that would be one of the advantages, I guess, for central bank money.
Okay.
Perhaps to add here, how to mitigate risks related to stable coins, as we have discussed before, also if Jason go to trusted issuers who are regulated, where there is some oversight that actually the real fiat assets are actually booked and available.
Yeah, this really comes down to the due diligence of each individual participating in the digital economy. You really need to, especially if it's not a regulated entity, you need to do your research on historical transactions, community, technology security, and everybody has their kind of own formula for their own risk. Some people are very mathematical about it, and others just have a gut feeling about it. But you definitely need to be thinking about those things when participating in these networks. Now, more and more we're seeing traditional finance participating in these networks, so that's a good sign. Doesn't necessarily mean that everybody has to agree to that. I totally respect people that want their full privacy, but again, you potentially are taking on more risk, in those environments.
All right, interesting. And here we obviously also have a role of technology again, also in risk assessment. And I think that's that has been also one of the drivers of peer-to-peer lending and these kinds of things, where technologists or tech companies actually believe that they can automate some of those processes using artificial intelligence and so on. Back to Q&A.
Cool. So next one is actually a thought experiment. How would the crypto community react if the central banks start to acquire Bitcoin in a fashion that they become significant Bitcoin whales, similar to how they build up gold reserves to back their fiat currency?
That's Thomas, and very interesting question. I like that.
Well, we have no plans at this stage to invest in Bitcoins. But
just the fact that you had to say it.
Exactly. I mean, we saw Elon Musk gave a little taste of what could happen. Of course, I mean, I don't see that in the foreseeable future as an asset that the central banks would use. But I mean, never say never.
All right. So you're leaving out the door, Robin, please.
Just a quick note on that, and this is my cynical hat as well. I'm probably a bit of a grump today, but I think if governments did start purchasing Bitcoin and use it as a reserve in the manner that they used to use gold as a reserve, I think it may be destabilizing for the overall geopolitical landscape. One of the wonders of modern monetary theory is it allowed governments to impose monetary policy, which meant that they didn't need to invade each other for the scarce resources, the minerals and the commodities, etc., and so on. So, I mean, in a dystopian future, if all these countries were holding onto private keys with all this Bitcoin attached to them, you might get a scenario when they start attacking each other because there's obvious wealth that they can go in and grab. And I'm not sure what a Fort Knox would look like for a private key, but I would imagine the cyber warfare would get fairly intricate and could lead to all sorts of negative consequences. That's my grumpy bear, cynical hat on. I don't know.
So speaking of cyber
ahead.
warfare, I'm curious, like, what you guys think is the future for stablecoins and CBDCs? Because like right now it's being used as like a geopolitical tool already, and it's kind of interesting to imagine like what the future would be like as the industry evolves.
Well, I can start with that. We have now, at least the U.S. government has released documentation that North Korea has tried to hack multiple exchanges, to essentially accumulate digital currencies. I imagine other nation states are probably doing the same in some regions of the world that we don't know about. So it's already been happening, in that respect. There's also a question here in the Q&A, what's going to happen when quantum computing comes into place and can potentially break some of the encryption, the public-private key encryption methods of these blockchains. A lot of the blockchains are thinking about that. The protocols are thinking about that. Some of them are creating "quote unquote" quantum safe encryption mechanisms, and it's going to be a constant back and forth, basically forever between the hacker and the economies, and that's just how it is traditionally. Take blockchain out of all of this. That's what we've been doing for years and years. So that's going to continue to happen. But kind of my primary point here is that we are getting smarter and better in this space. What I can tell you is if you look at the hacks that were happening 2009, 2010, 2011, all the way to 2014, they were much simpler and easier to perform from a hacking perspective. Now, not that hackers aren't getting better, they sure are, but we are getting smarter also on the technology. So we are getting into a little bit better of a place My worry is the individual consumer. As more, not as tech savvy consumers come into the space, using digital wallets and things of that nature, they're going to be at more risk, from just basic scams and hacks that happen, now with traditional accounts.
Super interesting. Yeah. The future of warfare, so to speak, between the crime side and the sort of the economies. It is, yeah, I see a movie plot right there. I mean, for a couple of movies actually, but getting the private keys out of somebody's hands.
Too bad most hacking movies are really terrible.
Well, here's an opportunity.
Mr. Robot was great though.
Right.
All right, so we're going to transition to the next question. The challenge with CBDCs and centralized power structures in general is always the potential to misuse that power. Do you think there will be tangible, reliable, or transparent safeguards against the misuse of CBDCs for the likes of financial censorship and overstepping of authority?
Well, I mean, guess that's addressed to me. So, or anyone else who wants to jump in, but I don't see it to be totally new. I mean, it's true. Centralized power there's clearly possibilities of use. At the same time, there are also a lot of advantages of centralization. And for me, one of the interesting issues to see now with decentralized finance is how it can go against these tendencies that are there for centralization. You see it with even with Bitcoin, you have wallets, you have exchanges, they are centralized, you need oracles, and so on. So there's a lot of centralization there too, even in the DeFi world. And I think the issue with CBDC and central banks is just to hold them accountable. There are laws. There are different possibilities how you can hold them accountable, but I think it's a real issue, and it has been there in the past, and it will be there in the future.
Yeah, I'm going to agree with Thomas. I mean, when it comes to centralizing anything, even if you're the largest token holder of a particular blockchain or cryptocurrency, you potentially have that power, regardless of a central bank owning it or an individual. And that can be quite scary. I look at mining operations, for example, especially for, the proof of work protocols, most of the Bitcoin mining operations are coming out of China, right? Does that mean that they have a particular amount of power over, the Bitcoin protocol? Maybe. Are they abusing it? No, not at the moment. But it is a potential, if they can potentially have 51% of the computing power, then they can fork the blockchain and use it for whatever method. I don't think that would occur, but again, we're getting to those points in some of these proof of work protocols where that could occur. Even in proof of stake, you have if you look at the differences of the stakeholders and kind of the commodity traders, the stakeholders still have a relatively much larger percentage and portion of the staked assets in those protocols. So again, you could consider that being like a central bank or a series of central banks that could control that economy. So we do have to be careful. I think this will change as volumes change, as more adoption occurs and volume distribution flattens out across more participants, then I think we'll be in a little bit safer of a situation.
Right.
Or I would say less risky. Let's put it that way.
Less risky.
Not so much safer.
What are some ways you guys think can different projects can decentralize better? Because every project is pretty centralized in different aspects.
So you mean like so what part of the project is sort of the centralized part, and how should that be distributed?
Yeah, so like in terms of like decentralization, you guys were talking about the risks tied to like centralized entities. So like if it's proof of stake, proof of work, how do you make sure the miners are decentralized? How do you make sure the token distribution is decentralized and different things like that? And then the projects that are built upon them, how do you make sure that who holds the keys? And it's like different things like how do we actually evolve this industry so it becomes more decentralized? So there is less centralized risk.
I mean, if you know, just generally speaking, between proof of work and proof of stake, you have a better chance of being more decentralized in proof of stake. And that's because you can physically distribute the tokens however you want, as opposed to mine them. With mining operations, it's really hard to be able to determine where the miners are going to end up, right? I mean, I think initially the miners weren't, you know, primarily China based or Southeast Asia based. You know, they were distributed quite nicely in the early days of Bitcoin, I believe. But with proof of stake, you, as the kind of token issuer, you have that choice where you're going to, you know, initially distribute the tokens or how you're going to distribute it. So you have a better chance there just from a basic distribution method. Now, after that, it really, I think it comes down to participation. You really have to have some sort of app or protocol where the exchange of the assets is happening on a scale to where the stakeholders are, you know, the amount of stake that they have in the protocol changes significantly over time and flattens over time across the participants.
Right. So it comes down, essentially, a lot of these things come really down to simple, or quote unquote simple, behavioral mechanisms where human decision making is actually at the core, and like it's sort of those mechanisms that we know from also traditional governance systems or so on are important. Interesting. I would say, like, maybe Hsin-Ju, if you agree, maybe two or three more questions, and then I'd like to go into maybe the final round where everyone on the panel is kind of gives their view on, also maybe their evolved view on where they're at.
Yeah, definitely.
Sounds great.
Let's see. Sorry, there's a lot of questions. So I guess like the next question would be, do you see a world where CBDCs can be used with DeFi, aside from being wrapped? Like, do you think CBDCs would somehow work with decentralized finance and financial instruments?
Here, I do think yes, because apparently the demand for stable coins seems to show to me that blockchains are looking for something like a CBDC. I mean, you would have something better than certainly an off-chain asset-backed stablecoin if you would have directly a CBDC on the blockchain. And that has been one experiment that we have been doing, for instance, at the Swiss National Bank, together with the Swiss Stock Exchange for the digital exchange. So I think there is clearly a possibility for central banks to centrally issue a CBDC on a blockchain that then can be used on a blockchain. So that would be my view.
Interesting.
Yeah, I agree with Thomas there. I do think that there's a way to do that. In fact, you know, the way that we're configuring Basket, you know, we would prefer to buy assets in CBDCs if we could. You know, right now we're limited to buying currency bonds across, you know, and trying to distribute those bonds across, you know, non-correlated assets. But yeah, it would be much faster and more efficient for us to use a CBDC in that process. So and then if you think about the kind of automated market maker space, this kind of DeFi swapping protocol, you can still go through all the KYC AML processes to stake your assets, for example, and then you can receive the incentives from those assets for staking, and you can still do that in a compliant way, I believe. Now, I don't believe the US regulatory space is like ready for that yet, but I think they will be. I think once they've, you know, understand that a little bit better, they would be able to do that. So that means you could still create these these nice liquidity pools with authenticated users that are still receiving those same incentives, and it can all be tracked and validated and verified through blockchain. So I do believe that that's a way that we will be going. It will just take time for the regulators to kind of fully understand that, because they're also learning about the technology, as well, and kind of catching up.
Right.
Perhaps to add here what Jason just said, traditional AML frameworks are targeting financial intermediaries because there are these identified, regulated, supervised parties. So you impose obligations about identification, about transaction monitoring. But this concept of financial intermediaries, it's not easily transferable to the DeFi space, where it's hard to identify at all such intermediaries. And this is exactly where existing AML frameworks are being challenged. And at the end of the day, if we have CBDC heavily involved in the DeFi space, which I do clearly see a strong use case for that, questions are actually, okay, how we do ensure that AML requirements are adhered to. And this is exactly the space where a regulated but innovative player can bridge this gap.
Very interesting. So basically, the panel agrees on yes, but maybe let's hear Robin.
Yeah, I mean, yes, I believe that they'll be interoperable. I think atomic swaps are already being developed, and I think it will be really interesting when we have kind of cross-chain compatibility, whether it's a CBDC, a stable coin, or open permissionless networks. I just wanted to touch on the AML question, because I do think the incumbent approach to AML is, as Gino says, based on financial intermediaries, and that is starting to break down now in these P2P environments. I think that the financial services sector needs to radically rethink what AML should be as we move forward. And I think it's not an easy question to have an answer for. Because one thing that has been proposed, or at least has been started to be discussed, is some sort of regulation surrounding the generation of a public-private key pair, which to police that would be very, very, very difficult. And I don't even see how it's possible, because you're attempting essentially to police mathematics. So I think some, elevated minds need to come together. I don't think they're necessarily at the FATF. I don't necessarily think they're in the existing regulatory circles. They may well be, I'm not sure. But I think an open discussion needs to be had between the existing incumbent system and some of the new players. And I think that discussion should be very transparent, and I think it should be held in public forums, and I think it should work towards, modifying the regulatory frameworks surrounding AML and CTF for the benefit of all, not just the benefit of the investigative authorities.
Yeah, I agree with Robin, and I will tell you, just from a KYC side too, the KYC processes that are being used in these regulated digital exchanges is I think actually better than some of the banking institutions, in fact, in terms of authenticating and verifying individuals that are doing transactions, and so there's much to be learned from traditional financial institutions, what's happening here in the digital space. What I will say about the DeFi and CeFi, which is centralized finance, and the kind of merger of those things, not everybody's DeFi is the same. I don't imagine a completely decentralized financial model with full privacy ever working with any of the central banks. It's just not going to occur. It's too high risk. And again, it doesn't necessarily mean that they wouldn't do it. It is just too risky, across the board. And so if your vision of DeFi is that, it's very unlikely that CBDCs will be involved. But there will be some cross section, like I mentioned, in automated market making and things of that nature that can be controlled in a way, but still decentralized in terms of who's staking their assets. I think that is definitely possible.
Cool. Hsin-Ju, maybe the last question, and could could everyone use the sort of the opportunity of that last question also to kind of wrap in their maybe their final viewpoint or sort of closing remark? I would say we should probably wrap up in about 10, 12 minutes. So take that opportunity as well to reflect on that question and your maybe also how has your viewpoint evolved in the last hour, maybe even. Go ahead.
All right, so we have two options in terms of questions. We can talk about licenses for different aspects of open networks, different parts of the stack, or we can talk about the digital yen. Do you guys have a preference?
I think you should pick, Hsin-Ju.
All right. All right, let's talk about the digital yen. There are many problems with it. I think it's one of those models where everyone looks at it, where it's kind of fascinating in terms of how it's being implemented, but there are a lot of risks involved with it. So I guess like when you guys look at what that CBDC, like how do you guys evaluate it? And like what would you do differently for like version 2 or like for other countries that are thinking about CBDCs?
Let's go. What would you do? Well, let's start with Thomas. He has just thought about this for the last 2 years. So let's do it.
I think just central banks are not there yet. No one really knows the best way or a good way to issue a CBDC. We are all kind of watching each other and waiting for each other to go. I mean, the Bahamas came out, I think, as the first ones with really a live CBDC. We have the cent dollar, but that's also a kind of an enterprise blockchain, if I understand it correctly. So I think we are just not there. I'm not too familiar with what the Bank of Japan is doing in this respect, I have to say. But when it comes to digital yen, just one point that might be similar to a digital Swiss franc is the yen and the Swiss franc are both safe haven currencies, which means that there are a lot of people from abroad holding the yen and the Swiss franc. And unlike the US dollar being a relatively small country, you have an issue here that you have an appreciation of your currency always, especially in times when there are a lot of risks in the market. So that is one of the issues that we are also taking into account. That could be an additional problem. And I think for digital yen, that would be very similar.
I will say a positive thing about it is that it will allow for many of the unbanked people in China to participate in the financial markets. So that is one of the things that the digital yen will allow for.
Gino, what's your, from a bank perspective?
My suggestion is to address also this other question about licenses and DeFi,
Nice.
to make that in parallel. And
yes,
the topic is interesting, but my counter question would be who would need to apply for such a license, right? Because it comes back to this question of centralization of financial intermediaries, because at the end of the day, you cannot license systems. There must be somebody accountable, somebody needs to apply for a license, an entity, natural person, usually not, so it will be a legal entity, and then you can impose the requirements to fulfill in order to get such a license. And there we have to ask, okay, what is the specific contribution of the players in such a DeFi space? Is it still financial intermediation? Is it sort of custody? Is it involvement in multi-signature? And this is just a little bit too early, because there are very innovative use cases, but at the end of the day, somebody needs to get this license, and then you can exercise supervision. That's just my 2 cents to that question.
so when I was talking about licenses, like I heard in Germany, actually, they're going to make proof of stake validators get a crypto custody license because they're doing governance on chain. So that's like tied to mining, which is like tied to a lot of like with consensus and validation. So it's like kind of interesting to see how like governments are starting to regulate different aspects of the stack. And do you see that like happening like long term, like everything will require a license?
Yes, I do see that tendency, and right now in the European Union, as there is no harmonized framework yet, several jurisdictions have different approaches. You mentioned Germany with the crypto custody license. There you need such a license if you want to provide custody services for third parties. And until MiCA will enter into force, other jurisdictions have different approaches. But the time where you could do sort of regulatory arbitrage going from country to country, this is not sustainable, it's not scalable. And then we come back to the trust, right? If you can say, well, I'm regulated and actually these are the requirements, and we have talked about cybersecurity, and here operational risks in losing or getting hacked, private keys are gone. This is posing a big threat of clients of such service providers. And here with regulations, then you need to also fulfill cybersecurity requirements and so on. So therefore, running away from regulation is definitely the wrong approach. And the right question here is, what sort of regulation does make sense? I advocate heavily for technology neutral and principle based, because that gives flexibility not to over-regulate and also reduce the space for innovation.
Very good. It's a great answer. Great, also great bringing together those two questions.
Yeah, I just want to touch on, just for me to sum up on the idea of regulatory arbitrage, because I think that's a really interesting topic in itself. But I think you may find, as central banks start to develop their own countries, that instead of regulatory arbitrage, you might get a form of monetary-based technological arbitrage, where states kind of monetary and fiscal ideology manifests in their central bank digital currency. And because we imagine that these central bank digital currencies will be interoperable, people would be free to choose which system they wish to transact with at any point given in time, depending on how their beliefs align with the system. So, not engaging in any moral relativism, the people in China may prefer to transact in their digital currency, whereas more privacy conscious people may wish to transact mainly in the Swiss central bank digital currency or the German central bank digital currency. And I think that would be really interesting, because I think you would get, well, you have the potential for some really beautiful systems to be built that are very open, very transparent, based on, really outstanding and beneficial principles, as Gino said. And that's what I would like to see. I have no reason to think that there couldn't be, for argument's sake, an open source permissionless central bank digital currency. I think it would be a very beautiful thing to imagine. Whether or not it'll happen, I don't know, but there could be.
Very nice.
Awesome. Well, I think we're going to wrap up questions now. I'll let Chris take it from here.
Thanks very much, and thank you for leading the Q&A very beautifully and engagingly. So I think I'm actually surprised how many facets this question has and where it led us. It is something that seems, well, there are two sides, and then we kind of know there's a gray zone between the CBDCs on one side and this sort of wild, immature market but that holds so much disruptive potential as well. And we're all watching history unfolding right now, and I think we have to be humble to a certain degree to say, well, we do have to really watch this. And some of us are participating on different, or I think all of us are participating in different ways in creating this sort of new world. And I think listening to each other and to each other's sort of not just visions, but also scenarios that can come out is absolutely essential in order to really build something where we all, or many of us, or hopefully all of us, can thrive and find a future that is something they want to live in. So the second point I've been not surprised by, but I'm very appreciative of, is the level of intelligence, the level of just willingness to share and contribute from everyone in the panel. So I would like to take this opportunity and really thank you also in the name of CBA for having such a great and high-level discussion, full of respect, but also full of your experience, your knowledge. And we touched upon really sort of technological poles. We touched on the pragmatics, but also on almost really central philosophical concepts. And I would like to kind of leave it at that. And also want to thank our audience for everybody who's watching this and who's interacting. I see there's a lot of interaction also on the chat, on the Q&A, which I think is a great thing. And I would like to invite everyone to keep going in this direction and to keep interacting and take all the opportunities you can to interact with policymakers, with founders, with projects. Don't be afraid to reach out to everyone and really bring in your voice. It's absolutely vital that we all build this together and we create our own future in a participative way. So thanks very much for being here, and keep following us on social media if you can. If you want, go to our website, CBA. Well, it's called Crypt. Great. I'm advertising the website and I'm forgetting it. cryptovalley.swiss, where you can also find a recording of this in a couple of days from now, uploaded, and also biographies of the folks who participated. So thanks again.